You believed that placing life insurance inside an irrevocable trust would shield the death benefit from estate taxes. The promise sounds simple: set up the trust, transfer ownership of the policy, and when you die, the proceeds pass tax-free to your heirs. But research into IRS code sections and estate tax case law reveals a darker reality. One structural error, a single mistake in how you fund the trust, can expose the entire death benefit to federal estate taxation. Let me walk you through a real-world example that illustrates this catastrophic planning mistake. Consider James, a 58-year-old business owner with a $2 million life insurance policy. His estate planning attorney recommended an irrevocable life insurance trust, ILIT, as the standard strategy to keep the death benefit out of his taxable estate. James signed the trust documents, felt confident about his planning, and moved forward. However, the attorney made one critical error during the funding phase, a mistake so common that the IRS encounters it regularly in estate tax audits. Instead of properly funding the trust with cash or securities that James transferred to the trustee, the attorney had James simply assign ownership of the existing life insurance policy directly to the trust without completing the required crummy letter process. This seemingly minor procedural oversight created a massive problem. Under IRC Section 2035, when a person transfers an existing life insurance policy within 3 years of death, the entire death benefit gets pulled back into the taxable estate, regardless of the trust structure. But that's just the first layer of this planning trap. Let's explore the fundamental mechanics of how life insurance trusts work and where most people go catastrophically wrong. The core promise of an irrevocable life insurance trust relies on IRC Section 2042, which states that life insurance proceeds are excluded from your taxable estate if you don't own any incidents of ownership in the policy at death. Incidents of ownership include the right to change beneficiaries, borrow against the policy, surrender the policy, or pledge it as collateral. By transferring ownership to an irrevocable trust, you theoretically eliminate these incidents. The death benefit passes directly to the trust beneficiaries outside your estate, avoiding estate tax entirely. The federal estate tax threshold in 2024 stands at $13, $61 million per person, or $27, $22 million for married couples. However, this exemption is set to sunset on December 31, 2025, reverting to approximately $7 million per person, indexed for inflation. This creates enormous urgency around life insurance planning. Families that fail to implement or properly fund an ILIT before the exemption drops could face unexpected tax bills of 40% or more on death benefits that could have been sheltered. According to research from the American College of Financial Services, approximately 35% of high-net-worth individuals with life insurance trusts have structural deficiencies that could trigger unexpected tax liability. These aren't rare edge cases. They represent systematic failures in implementation that cost families millions annually. Now, let's examine the specific funding mistakes that trigger the Section 2035 3-year rule. When you own a life insurance policy and transfer it to a trust during your lifetime, the IRS presumes that if you die within 3 years, you retained substantial control over the policy. This presumption essentially negates the entire ILIT strategy. Consider a second case study. Susan established an ILIT in January 2021 and transferred her existing $5 million policy to the trust in March 2021. She died unexpectedly in October 2023, 32 months after the transfer. Because her death occurred within the critical 3-year window, the IRS assessed the full $5 million death benefit against her estate. Her estate tax bill ballooned from $0 to approximately $600,000, forcing her heirs to liquidate assets at unfavorable prices to pay the unexpected tax. This 3-year rule creates a fundamental timing constraint that many people don't fully appreciate. The solution requires either purchasing a new policy after the trust is established, with the trust as the initial owner and beneficiary, or waiting 3 years after transfer before planning your estate to account for the Section 2035 inclusion. Most estate planning mistakes stem from transferring an existing policy without respecting this timeline. But there's a second category of funding mistakes that's equally devastating: the crummy letter requirement. When you fund an irrevocable trust with cash so it can purchase or pay premiums on a life insurance policy, that contribution technically represents a taxable gift, unless it qualifies for the annual gift tax exclusion, $18,000 per individual in 2024, or $36,000 for married couples. To claim the exclusion, trust beneficiaries must have what the IRS calls present interest in the contribution, meaning they have the right to withdraw the money during a specified window, typically 30 days. This withdrawal right is created through a crummy letter sent to beneficiaries informing them of their right to withdraw their share of the contribution. Failing to send proper crummy letters creates two problems. First, the annual gift tax exclusion is lost, forcing you to use your lifetime gift tax exemption. Second, If your contributions exceed your available exemption, you actually owe gift tax. The failure to implement crummy letters properly has resulted in substantial audit adjustments by the IRS. Let's examine a third case study. Robert funded his ILIT with $50,000 annually for 5 years to pay life insurance premiums, but his trustee never sent crummy letters to the beneficiaries. He believed the trust structure itself provided the necessary present interest to qualify for the annual exclusion. When the IRS audited his estate, they disallowed the exclusion for all 5 years, $250,000 in contributions, lost the ability to use his annual gifts tax-free. Robert's lifetime exemption was consumed rapidly, and his estate faced unexpected gift tax consequences. The third critical funding error involves co-ownership and policy loans. Many people fund an ILIT by taking out a loan against an existing policy, with the loan proceeds going to the trust. However, if the original policy owner retained any control, such as the right to borrow additional funds or change the loan terms, this retained right can constitute an incident of ownership. The policy remains partially taxable in the owner's estate despite the trust structure. The counterargument sometimes raised is that certain modern ILIT structures, particularly intentionally defective grantor trusts, IGD, intentionally retain some grantor powers to create income tax benefits while still excluding the death benefit from estate tax. However, these sophisticated structures require precise documentation and compliance with specific IRS requirements. The line between a beneficial grantor trust and a fatally defective one is razor-thin and frequently misunderstood by practitioners. Dr. Natalie Choate, one of the nation's leading life insurance trust experts, emphasizes in her research the 3 most common ILIT implementation failures are: 1. Transferring existing policies without respecting the 3-year rule, 2. Failing to establish proper crummy procedures, and 3. Retaining inappropriate incidents of ownership through policy loans or amendments. Any single one of these errors can eliminate the entire tax benefit. There's also a fourth funding category often overlooked: the initial death within 3 years of trust creation. Even if you purchase a new policy with the trust as owner, avoiding the Section 2035 issue, if you die within 3 years of creating the trust itself, the IRS may argue that you retained enough control through trust amendment or distribution decisions to pull the death benefit into your estate. The case law here is somewhat favorable to taxpayers. Courts have generally required more than mere ability to amend to establish included incidents, but litigation risk remains significant. Additionally, funding an ILIT with community property or inherited property creates its own complications. If you fund the trust with community property, both spouses' interests must be carefully considered. If you fund with property you inherited with a stepped-up basis, moving that property into an irrevocable trust locks in the current basis and may eliminate basis step-up benefits for your heirs. The proper funding protocol requires: 1. Establishing the irrevocable trust with the trustee fully understanding the death benefit objective. 2. Either having the trust purchase a new policy as original owner or waiting 3 years after any policy transfer. 3. Implementing documented crummy letter procedures for all cash contributions. 4. Ensuring no retained incidents of ownership. And 5. Maintaining meticulous records of all funding transfers. For married couples, coordinated ILIT planning across both spouses, with careful consideration of portability elections and ultimate exemption planning, adds another layer of complexity. Many couples establish separate ILIT for each spouse, funded equally, to maximize the use of both spouses' exemptions, but coordination must be precise. The bottom line: a $1 million life insurance death benefit can indeed become fully taxable due to a single funding mistake. The stakes are enormous. The IRS actively audits these structures, and the rules are unforgiving. Proper implementation requires experienced planning, careful documentation, and rigorous compliance with technical requirements.